All right, today we're going to talk about one of the biggest leaps any trader can make. It's that move from trading on instinct and pure emotion to having a clear, repeatable process. We're talking about going from total chaos to being in control, and we do that by diving into the world of systematic trading.
I mean, have your emotions ever just completely hijacked your trades? If you've ever felt that pit in your stomach during a losing streak, or that crazy high from a big win, you know exactly how easy it is for emotions to just grab the steering wheel. For a lot of traders, especially once you're past the beginner stage, this is the biggest hurdle, right? Just relying on gut feelings, which, let's be honest, usually leads to unpredictable results and a ton of anxiety.
And this right here really lays out the two paths you can take. On one side, you've got emotional trading. It's basically just stressful guesswork, the whole shebang. But on the other side, you've got systematic trading. And that's the solution we're talking about. It's rule-based, it's disciplined, and it's repeatable. Really, it's all about replacing that feeling of panic with an actual plan.
Okay, so first things first, let's really dig into the problem we're trying to solve here, which is what I like to call the trader's emotional trap. It gets so many of us. So for those of you who've moved beyond the absolute basics, you're at this really critical stage. You know enough to be dangerous, right? But relying purely on instinct or just what feels right in the moment, that is a recipe for disaster, or at least a recipe for total inconsistency. A structured system, on the other hand, gives you the roadmap you need to navigate all those market ups and downs without your emotions getting in the way. So how do we actually build that roadmap? Well, that's where we get into building your own trading system. And look, having a robust system isn't just some nice-to-have idea. It's literally the blueprint for long-term success. So what is a trading system exactly? The best way to think about it is like a pilot's pre-flight checklist. It's a set of predefined rules that covers everything. When you get into a trade, when you get out, how you manage your risk, all of it. The whole point is to take your emotions completely out of the equation.
And at the end of the day, building one really comes down to these three pillars, super important. First, you have to define your strategy, the specific signals that tell you when to pull the trigger. Second, you master your risk. That means knowing exactly how much you're willing to lose on any single trade. And third, and this is a big one, you test everything. You use historical data to see if it works before you put a single real dollar on the line.
All right, so now let's peek inside the toolbox. Let's look at the actual strategies you can use. And I gotta say, there is no one-size-fits-all approach here. Think of different strategies like specialized tools for different jobs, or in our case, for different market conditions.
And what's really fascinating is that you can start with two approaches that are basically polar opposites. First, you've got trend following. This is all about riding a wave, right? The idea is that a market moving in one direction is probably going to keep going that way. But then you have mean reversion, which is the complete opposite. It's a bet that prices that have gone way too far from their average will eventually snap back, like a rubber band. And the list just keeps going. You've got breakout trading, which is all about momentum. The goal here is to catch those big explosive moves when a price smashes through a key support or resistance level. You can think of those as price floors and ceilings that everyone is watching. Then, on the other hand, you've got something totally different, like pair trading. This one's market neutral, you're buying one thing and selling another related thing. Just betting on how they perform relative to each other, so you don't really care if the whole market goes up or down. You just need that relationship between your two assets to work out.
Now, if we go to the real cutting edge of all this, you'll find high-frequency trading, or HFT. This is a whole different ballgame. We're talking about powerful algorithms and supercomputers executing thousands, even millions of trades in the blink of an eye. The goal? To capitalize on these tiny, microscopic market inefficiencies that only exist for a fraction of a second. So HFT really boils down to three core concepts. First, there's latency. This is just an absolute obsession with speed. We're talking milliseconds, making the difference between profit and loss. Then there's arbitrage, which is basically exploiting tiny price differences for the exact same thing on different exchanges. And finally, market making. This is where firms provide liquidity to the market by placing both buy and sell orders, and they make their money on that tiny gap in between, called the spread. Okay, so let's say you've picked a strategy. Now what? How in the world do you know if it actually works without losing your shirt? Well, you put it in a flight simulator. And in the world of trading, we call that backtesting. And this quote right here just says it all. Seriously, backtesting is a completely non-negotiable step. You cannot skip it. It is your one chance to see all the flaws in your system, to understand its potential strengths and weaknesses, all using past data. Think of it as the ultimate stress test for your strategy before you risk any real capital.
Let's look at a quick case study to see how this works. So there's this trader, let's call him John. He built a pretty simple moving average crossover strategy. It's a classic. It generates a buy or sell signal when a short-term average crosses a long-term one. So he runs his initial backtest and it shows an 8% annualized return, which, isn't bad. But it came with a pretty significant amount of risk. And this is exactly where optimization comes into play. For John, this didn't mean throwing his strategy out and starting over. No way. It just meant fine-tuning the parameters. He tweaked things like the length of those moving averages, and he added something called a volatility filter. That's just a simple rule that tells his system, hey, when the market gets super choppy and unpredictable, just stay out. And check this out. This chart shows one of the biggest wins he got from that optimization. His first strategy had what's called a maximum drawdown of 25%. That's the biggest drop from a peak to a low point. Ouch. But after he optimized it, he knocked that drawdown all the way down to 18%. That is a huge improvement in how resilient the system is. And guess what? The return got better too. By adding that volatility filter, John's system was able to dodge a lot of those false signals that pop up in messy, choppy markets, which cut down on a bunch of unnecessary losses. And the result? His system's annualized return in the backtest jumped from 8% to 10%. So you get better returns with less risk. That is the power of testing and optimization. But listen, there's one final, absolutely crucial piece to this puzzle. No system is ever set it and forget it. That just doesn't exist. Markets are always changing, and your system has to be able to adapt with them. Remember that pilot? Well, the pilot also has to know how to handle unexpected turbulence. And this table here sums it up perfectly. It's all about matching the right tool to the right job. So when the market is clearly trending up or down, that's when you pull out your trend following or breakout strategies. But when the market is just stuck in a rut, moving sideways in a range, that's when strategies like mean reversion or pair trading are really designed to shine. So at the end of the day, the goal is to be dynamic. The truly great systematic traders, they aren't just robots following rules blindly. They have a deep understanding of which set of rules to apply based on what the market is actually doing at that moment. Look, building a trading system is so much more than just a technical exercise. It's really an act of discipline. It completely transforms how you interact with the markets. It becomes your personal rulebook for navigating all that financial chaos out there. So the only question left is, what will yours be?